Welcome to our 2021 webinar series. LLIS believes that in 2021, knowledge is key. Each month, you'll learn key insurance solutions to better your insurance knowledge. Our insurance specialists keep up with the constant changes in the insurance industry, especially during a pandemic. Our specialists will review some basics, use case studies to show how LLIS crafted risk management strategies, and answer your insurance-related questions. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer them as we go. Today's webinar is being recorded and will be posted on our website within a day in case you missed it. Today's presenter is constantly monitoring the insurance and financial services industry and providing you and your clients with the most up-to-date recommendations. Please welcome Mark Maurer.
Hi, everybody. Thank you for tuning in today. And I know many of you have had questions in the past that you wanted to know about insurance, but were afraid to ask because they were too spooky. Yes, that's what I do. My kids love me around Halloween. So we're going to jump right into a whole lot of different questions, and some of you are probably going to have them as we go along. So like Claudia said, please type them in along the way, and I will do my best to answer them as we go. So away we go. The first thing we're going to talk about is long-term care insurance. So when we look at different options for your clients, what are some of the questions that come up? First, what's the difference between a reimbursement and indemnity long-term care insurance policy when it comes to going on claim? So you have two different types of how benefits are paid to the insured. Traditional long-term care policies and some of the hybrid policies use a reimbursement type design, which probably works about exactly as you'd think. You're reimbursed. And so the insured is required to pay for the care in any given period of time, usually on a monthly basis. And then they have those receipts, invoices, whatever they might have, and then submit it to the insurance company for, that's right, reimbursement. There it is. How does this work? You normally have a daily or monthly benefit on a long-term care policy. So if it's a daily benefit of, let's say, $100, you have care of $80, the insurance company is going to reimburse you $80 for that day. If you have care of $120 for a day, the insurance company is going to reimburse you $100 because your daily maximum was $100. And so that other $20 comes out of pocket. If you had a monthly benefit of, say, $3,000 a month, 100 times 30, the 80 would be covered, the 120 would be covered until you come to the end of the month, and is the month total $3,000 a month. So the daily, if you use that $80, you have a max of 100 and then only use 80, that $20 stays in the pool of benefits, so it extends the length of time somebody can receive care at that point. So it's not a use it or lose it if your daily is 100. Anything you don't use in any given day stays in your pool of benefits. And part of what the reimbursement's looking at is who's providing the care. Wanting to make sure that the care is being provided by licensed caregivers to be eligible for reimbursement to protect the client from harm, prevent against fraud, all those sorts of things. Now, an indemnity policy, usually at the beginning of each month, once somebody goes on claim, satisfies the benefit triggers, not being able to perform the two of the 6 activities of daily living or cognitive impairment, usually expected to last for at least 90 days, then the indemnity policy, which is sometimes on older long-term care policies and some of the hybrid policies today, the life long-term care policies. The insurance company is going to send a check equal to the monthly benefit. Usually you have to have some sort of care in any given month. The insurance company is going to want to see that you're actually on claim, you're receiving, you need care, something each month But let's say it's one nurse's visit a month for $50. The insurance company is going to write a check for $3,000 a month, every month. So you don't have to submit invoices to see how those benefits were used every month. So usually there's some sort of check of a licensed person, but that can be fairly minimal. So then that money can be used to have a family member or friend provide some other care, because you, the client, are receiving that, say, $3,000 check, and you can decide how you want to pay it out. I see one question: when should someone start seeking long-term care insurance? I'm going to touch on that in a little bit. And then, yep, another one looks very similar. So we're going to go on. I see it. We'll get to it here momentarily. One of the questions we get: what are the advantages of a hybrid life long-term care policy over a traditional long-term care policy? Well, a hybrid policy has some benefits that a traditional long-term care policy does not. They all have very similar benefit triggers: 2 out of 6 activities of daily living or cognitive impairment, tax-free long-term care benefits, usually daily, monthly benefits. You can even have inflation riders on them. So as far as receiving the benefits and the long-term care design, it's almost exactly the same. But when we add in the life insurance component to it, we now can have a guaranteed premium. Traditional long-term care policies are what's called guaranteed renewable. So it's like our health insurance. Can't be canceled, but rates can go up. There's a traditional long-term care policy. Hybrid life policies can have a guaranteed premium, so it's fixed no matter what, even though it has the long-term care benefit riders to it. Another plus is the death benefit. One of the things that people aren't, because long-term care insurance, we don't see it as a necessary thing like our homeowners and our auto insurance, which are sort of a pure type of insurance. It's that benefits if we need it, but there's nothing there if we don't. Long-term care is like that. Long-term care benefits if we need it, nothing there if we don't. By blending it with a death benefit, then there's long-term care benefits if we need it. If we don't, there's a death benefit that passes on to somebody. So those premiums I paid for it, either I'll use as long-term care benefits, or my beneficiaries will receive some form of death benefit for the premiums I paid. And hybrid policies can have a return of premium too. So let's say you don't use it for long-term care insurance, you haven't died yet, so there's no death benefit. You can potentially get the money back that you put in. Now, I would say this is the very last place that if someone needs some access to cash values, they should be going, because by that point, you're probably older, you're much more likely to use the long-term care benefit. So I would say it's the last place you'd ever want to go to use cash values, start accessing it, but it's there if you need it. And sometimes it just helps you sleep better at night, knowing that there's a cash value there. Great, has the long-term care benefits. My advisor told me to do that. I'm not 100% sure, but even if I could just walk away and I'll get my money back, I feel pretty good about that. One question: are indemnity policies generally more expensive for the same coverage? Not necessarily. So most traditional long-term care policies today don't have an indemnity option. They're all reimbursement. So it's not really an option. On the hybrid policies, most of them are actually indemnity, because I think it's easier for the life insurance company to sort of balance the claims as compared to collecting and looking at receipts. So sometimes an indemnity hybrid actually has a lower premium than a reimbursement hybrid. Good questions. So here's Sally. She's age 55. She lives in Tampa. And here in Tampa, the costs for a nursing home are about $11,000 a year. So we looked at a monthly benefit policy for her of $5,700. Covers 50% of the cost of nursing home, is going to cover most, if not all, the costs of home health care, assisted living facilities. So in general, when we're looking at long-term care policies for your clients, we're not usually recommending an $11,000 a month benefit that's going to cover sort of every conceivable cost that they might have if they need care. But it's going to cover some. And the 50% of nursing home usually does pretty well if they were getting care at home, may cover most of that. So it's a nice mix of how do we transfer some risk to an insurance company. I'm still retaining some risk with my assets, but not having a giant long-term care policy premium every year. So when we compare a number of different things, with the traditional long-term care policy, $5,700 a month, 4-year benefit period, 3% compound inflation rider. Like I mentioned, there's no death benefit. You pay for it. It's like your homeowner's auto insurance. At the same time, I don't drive around every day. I really kind of hope I get hit going home today because I've been paying for my auto insurance all these years and I've never had to file a claim. No. I hope that's money that I never have to use, or insurance I never have to use. And there's no cash value. It's just sort of a pure insurance, and it's a reimbursement type policy. $71.64 premium every year. A hybrid life policy. Sally looks like she's 100. Yes. You know, 55, maybe that's, 50% of her age. I like that. The hybrid policy. Same monthly long-term care benefit, same triggers, same benefit period, same 3% compound inflation rider. If she has the policy and never uses it for long-term care, then there's a death benefit of $146,980. And in year 11, there's a cash value of $146,980. In this case, that's an indemnity type policy. It's kind of funny that the cash value and death benefit are exactly the same. Well, this particular policy, most of the hybrid plans have a short pay design. 1 or 2 you can pay to age 95, but many of them have a short pay design where it's either going to be paid up at 10 years by age 65, some sort of smushed premiums. So in this case, the premiums are almost $14,700 a year, but for 10 years. So instead of paying $7,000 for life, paying a little bit more than double that, but only for 10 years. And if she doesn't need it for long-term care, somebody gets a death benefit of basically the premium she paid back in. And if she changes her mind in 11 years for some reason, doesn't want to do it anymore, doesn't want to keep the policy, she has a cash value of the premiums she paid in. One of the things that's neat, or in this case, Sally's sort of an ideal person here, otherwise besides being, I think, 100 years old, is that at age 55, hopefully the kids are out of the house, or if they're out of the house, their college is paid for and all of that. She may have 10 more years to work, so she still has income coming in. If we can we need long-term care, if we're planning for long-term care, if we can accelerate those premiums over the next 10 years while she's still working for 10 more years, then when we get to retirement age, hopefully at age 65, then we don't have that long-term care premium continue and ongoing. So ideally, we can take do that short pay, use it, fund it while there's still income coming in, and then when income is not coming in anymore because we're retired, then that premium isn't continuing the $7,000 a year. So for clients who have that ability, are looking at long-term care, I really like the idea of the hybrid, even though it's higher premiums, but getting them paid off at all finished up by the time they get to retirement age. And that's pretty much what I said. One of the questions we get, what should I expect for rate increases going forward on long-term care policies? So this one, I'd love to know. If I could give you the answer, that would be would be fantastic. But then I could probably pick all the NFL games this weekend. I could probably know what the lottery was going to do this weekend, and so I don't know. But what we do know is that in the past, long-term care policies came on the market somewhere in the late 70s is when people really started looking at these. And insurance companies didn't really know how to price them because such a thing didn't really exist anymore before that. And back in the 70s, who knew we were going to have assisted living facilities? They didn't know how if people were going to keep these policies for forever, like they really do, or are they going to trade them like whole life policies to term policies to a new term policy? So it didn't know sort of what the lapse history was going to be. It didn't know what claims experience was really going to be like. And what they realized is that there were a lot of things. 70s and 80s, I think interest rates were probably in the teens. So when you price something that's based on interest rates that are higher than what you're earning now, you don't know what your claims experience is going to be, and you don't know how long people are going to hold these policies. You price them too low. And that's really what happened with some of the older policies. Fast forward, every year that goes by, insurance companies have much better claims experience. They have much better knowledge of lapsing, which realistically people don't. Because if you bought a policy 10 years ago, your benefits have probably grown. You're 10 years older. You probably aren't as in good of health as you were 10 years ago. So for the most part, people hold on to those policies as long as they can. And interest rates today, I think every time you turn around, it says historic lows. They're just not going to go as far as that, but they're very low, and they've been low for a while. So insurance companies have better history of how policies are being used, and today are using low interest rate assumptions because that's what we have. And so additionally, they changed some of their policies. Used to be dozens of insurance companies had long-term care policies. I think today it's maybe a dozen who do any sort of significant number of policies. And everybody had little nuances, little different riders, things try to separate themselves. As the industry consolidated to like I said, maybe a dozen companies, they realized needed to keep it simple, keep it to a few riders, make it fairly straightforward for people, and then some other pricing like the gender-specific pricing. Women cost more for long-term care. Long-term care premiums for females are higher than males. They take up they're a higher percentage of people in nursing homes. They tend to be the last claimant or the last person alive of a couple because women tend to live longer than men. So female rates are much higher. So whether in the past men were paying, women were paying too little, were men paying too high, or is it now just right? Don't know. But a lot of those things change. So with different pricing, different assumptions, different interest rate assumptions, different claims experience, hopefully with all of that, everything that's newer has a less likelihood of a rate increase than things in the past. So for example, Mutual of Omaha has had rate increases on some of its older policies, but their current policy series since 2013 has not had a rate increase. Now, what do insurance companies do? Mutual of Omaha has repriced their policy for new ones. So a person buying a policy today, a 60-year-old buying a policy today probably pays more than a 60-year-old who bought a policy 2 or 3 years ago, but they haven't gone back to existing policies or existing insureds and say, this policy you bought 5 years ago, we're raising your rates. So what's the future going to hold? I don't know. One question, is shared care available on the hybrid policies? Yes. So there is, we're sort of about to talk about that, but there is a joint hybrid annuity with the long-term care rider. and a joint life insurance with a long-term care rider. So yes. Is it easier to qualify medically for a long-term care policy or a hybrid life long-term care policy? It really depends. So with the hybrid policies, insurance companies first are looking at it as long-term care coverage. Make sure there's no morbidity concerns. So morbidity is living too long as compared to mortality, which is dying too soon. And so they look at the long-term care first and then look at the mortality issues with the life insurance. From my experience, because the premiums tend to be higher when we're adding that life and long-term care rider, sometimes the hybrid life long-term care policy can be a little more generous, a little more lenient than a traditional long-term care policy. I think because of the sort of lower premiums, a traditional long-term care policy of the three tends to have the strictest, I'm not sure strictest is the word, most stringent underwriting. But then is it easier to qualify for a long-term care policy or a hybrid annuity long-term care policy? Of the options, traditional long-term care, life with long-term care, or annuity with long-term care, the annuity long-term care policy is going to have the most lenient underwriting. And I think a big part of it is because it effectively has a very long elimination period. So using very round numbers, you may have a $100,000 single premium, and it creates a $250,000 long-term care pool. Sounds pretty good. It is good. How the policy works is that you really have two pools of money. You have a $100,000 pool, which is basically your own and your payment, your premium into the policy, and a $150,000 long-term care extension rider. Between the two, you can get $250,000 out of the hybrid annuity. But the first money I use, when I go on claim, when your client goes on claim, the first money they use is that the premium money. So if they use $50,000 of long-term care benefits, let's say, and then pass away, their beneficiaries get $50,000, the balance of the unused annuity. They don't get 250 or anything else, they get 50. So as I start going on long-term care claim, the first money I'm using is my annuity money, my own money. And then once I use up the first $100,000, then there's $150,000, which is the insurance company's money. But it may take me a year or 18 months to use up my own money first. So really, the hybrid annuity is like maybe a 1-year elimination period long-term care policy, or 1.5 years. And insurance companies realize that the longer that I have my elimination period, the lower the premium can be, the less likely some people may be to ever get to that point where they need it for long-term care. So that's how it's more lenient, is because it's like having a long elimination period that many people may not use. So it's a good way so insurance company can be a little more flexible in who gets it. So they can be a little more generous to say, this person may or may not be in ideal health, but it has a long elimination period, so we're willing to accept that risk. I see a cash benefit on a few long-term care insurance policies. How does that work? With a traditional long-term care policy, you may see something that says it has a $3,000 monthly benefit or a $1,000 cash benefit. So it's like a small indemnity benefit within the reimbursement policy. So if the client goes on claim and they have this $3,000, $1,000 a month benefit, in any given month, they can decide how to use their benefits. So if I want, I can say this month, use my cash benefit. And the insurance company is going to send a client a check equal to 25 or 30% of the monthly benefit. So using my example, round numbers, $3,000 monthly benefit for reimbursement, or this month, go ahead and send me a check for $1,000. I'm going to do something else with it. I don't know what it might be, but that's how it works. Don't have to submit invoices of how the money was spent. Can be used to pay your neighbor or your kids. Still may have to show that you got care that month, but you got $1,000 this month instead of reimbursement for $3,000. What's neat is, though, that the unused $2,000 stays in my benefit pool to be used later. So it's not like that this month I either had $3,000 or $1,000. If I use the $1,000 check, well, it goes away. No, essentially that unused $2,000 stayed in my pool of benefits to be used later on. So it just extends the period of time when I can use benefits. So, or if somebody's having more than $1,000 a month in benefits, probably just want to use it as reimbursement. Use my $3,000 a month. So it just adds some flexibility there. But the key is, it's not that if I use $1,000 in cash, it takes $3,000 out of my pool of benefits. It doesn't do that. I use $1,000 this month. That $2,000 just stays unused, stays in my pool of benefits to be used later. And this is coming back to some of the one of the early questions. What's the right time to look at long-term care insurance? Well, if your state is like Washington State, who implemented a payroll tax to fund a state long-term care program, the answer is right now, right away, ASAP. Do not pass go. Do not collect $200. Right away, right now. We have the state of Washington. We worked with a lot of advisors and a lot of clients. The date for people to have a personal long-term care policy in place to opt out of the payroll tax is November 1st. A lot of insurance companies stopped accepting applications back in August because they've been overwhelmed with applications. So I still have people calling me now and asking, hey, I was just reading about this payroll tax in Washington. Can I get a policy? I have to tell them, unfortunately, with less than 2 weeks, it's just not going to be an option. So as those things come out, pay attention. Don't wait. Do it right away. Otherwise, ignoring that, I think it's a good idea to start having the conversation for people who are getting closer to retirement than not. When you're 30, you're looking at having kids, saving for retirement. You're looking at your 401k, you're looking at maybe a 529 plan, you're looking at your mortgage and going, oh my gosh, my mortgage is giant. And all those things. Long-term care just doesn't seem like anything you can wrap your head around. So at some point, our mindset changes between I'm more worried about building up enough than to spending down too quickly what I have. And that's sort of the retirement long-term care time frame. Even thinking about maybe premiums that I've been paying for disability coverage, maybe let's reallocate that same premium towards long-term care benefits. Or you have parents or family members who need care. That makes it real for people. Sometimes having to be a caregiver for a parent, talking to your cousin who's having to care for your aunt or uncle, all makes it real. And that starts to be about age 50 in our experience. So that's about the time, I think, those two really good times to start talking about long-term care insurance with clients. So we're going to transition to disability insurance. Somebody asked, are your mid-40s too early? I don't think so. I think that's a good time to start talking, start thinking about it. Mid-40s for long-term care is probably great because it's before people have had their first heart attack. It's before they've been diagnosed with breast cancer. All things that maybe aren't going to impact them too much long term, but there's all those sorts of things. The earlier you can do it, the more likely you are to qualify, more likely you are to get good rates. Is 62 late? No, not at all. 60 is fine. Usually most insurance companies can go, I think, issue maybe 75 or 79. What if there's a history of memory care? If anybody's had a history of memory care, they're not eligible. Just straight out. Remember the 2 triggers: inability to perform 2 out of 6 activities of daily living, or a cognitive impairment that requires hands-on or standby assistance. Insurance companies see somebody who has a history of any type of memory care, that's just a precursor to having dementia, Alzheimer's, something like that. So that will be, any history of memory care for a client is going to be a non-starter. Some insurance companies even ask about history of Alzheimer's and things like that, and look at how many family members, how close a relationship was it. So good questions, everybody. All right, disability insurance. And I like all the questions. I will follow up with them either after. If people want to hold on, I can email people individually, but all are good things. What's the difference between COLA and FIO? So FIO, future increase options, allow someone to increase their existing benefits based on their increased earnings from when they purchased the policy. And the cool thing is there's no medical underwriting, no health questions. So I got the policy when I was making $100,000. 3 years later, I'm making $150,000. If I have a future increase rider, increase option on my policy, I can tell the insurance company, send them my financial documentation, and they say, great, you're eligible for additional benefits. We can increase your monthly benefit from $5,000 a month to $7,500 a month. So it increases my monthly benefit on my policy while I'm working now, while I'm not on claim. So it increases the starting point if I were to go on claim for disability. Now the COLA, cost of living adjustment, sounds similar, but it's when you're on claim. So COLA increases if I go on claim and I'm getting my $7,500 a month and I'm on claim for more than a year, then the COLA rider kicks in and says, we're going to increase your $7,500 a month that you've been receiving for the last year by either a fixed increase, some sort of CPI calculation on a compounding basis. So every year that I'm on claim, the COLA rider is going to increase the payments I'm receiving. So the key here is the COLA increases my benefits sort of after claim while I'm receiving benefits. The FIO, I'm purchasing additional benefits while I'm working to make a higher starting point on my disability benefits. What does own occupation cover? Disability insurance, there's a number of different riders or definitions of this, not riders, definitions of disability. So let's look at here, client on disability coverage. $200,000 disability or $200,000 income as a family practice physician. They become disabled as a family practice physician and they're not working. So whether it's a catastrophic disability, they're not able to work, or just not choose not to work, but can't practice as a family practice physician, whether it's a UROC definition, which is sort of a preliminary or the initial, not the any occupation that we may see with a lot of group coverages, but a UROC, which is a sort of the base definition in a traditional disability policy or individual disability policy. Transitional, own occupation, inability, not able to work, disabled as a family practice physician, $8,000 monthly benefit, client gets $8,000 a month. Now what happens is if somebody goes back to work, so in this case, they're a family practice physician, still disabled as a family practice physician, but working in a new occupation, in this case, it's going to be teaching. So there's some health issue, disability, that prevents them from being a physician, which was their occupation when they became disabled, and are choosing to go back to work in something else. So with a UROC definition, using the residual benefit rider, as you go back to work and start earning an income, as your income goes up in one pocket, your disability benefits start to go down in the other pocket. So as you go back to work, start making more money, your benefits start to decrease. Transitional occupation here in the middle is sort of in between the two. It looks to say income plus disability benefits more than what my pre-disability income was. In this case, no, income plus disability benefits is still less than my $200,000, so still receiving $8,000 a month. Own occupation, new income is ignored, and that's the key here. She's unable to work as a family practice physician. That was her occupation when she became disabled. She chooses to go back to work. It doesn't matter what it's in. She could be running Tesla and making $1 million a year. Still going to receive $8,000 a month from this policy because she can't work as a family practice physician. And this really just highlights that using more numbers. With this policy, if she's making $105,000 from her occupation as a teacher, 105 plus her $8,000 a month from the disability policy, it's still going to keep paying. So it's possible that at this point, she's making more by being disabled than when she was working. Now, more than likely, these numbers should be a little skewed. If she was a doctor, maybe it should be closer to 250 or 300. The teacher number might be about right. So it's still unlikely that between all of those things, again, unless she can, run Tesla, it may be unlikely that between those two, it's going to happen. But if you have someone like a doctor who, I have doctor friends who feel like they've been in school for forever, 20 years of income or 20 years of school and classes and education to get to a point where they're making good money, their next best thing is probably a long way off as far as income earning potential. So having that own occupation provides some peace of mind that if I couldn't do my specialty, then I'll be able to still collect the full benefits, even if I can work in something else. Social Security benefits, if someone asks, someone says, I already have Social Security, I don't need disability coverage. It's really hard to qualify for. And group coverage, if you have group coverage, most group plans are integrated with Social Security disability benefits. So even if you have group coverage and you go on claim, they're going to ask you to apply for Social Security benefits, because if you receive Social Security benefits, your group reduces what they're going to send you. So they're going to work that in. The good news, at least for group coverage and being reduced, is that in order to qualify, it's pretty hard. Usually expected to last at least 12 months or result in death. Usually it's, and some minimum, maybe not expected to earn $500 a month. I remember at one point, I think it was $900 a quarter. It's a very high threshold on not being able to qualify for Social Security benefits. But because of that high threshold, it's not a good, it's not a good backup plan for most people. So hopefully that wasn't too scary, because if you have any life and disability questions, life and underwriting questions, who are you going to call? You're going to call the Ghostbusters. I hope at least some of you all have seen this movie. It's one of the great ones. If probably everybody on the call, at least at some point, has seen the quotes that we send out to clients or even to you, and it looks a lot like this. It has two columns here: $1 million, 20-year term policy, male in Florida. And we get this question a lot. What's the difference between the preferred plus and preferred rates? I see two columns, one's in the $600, one's in the $800. What's the difference? Why wouldn't I just pick the preferred plus? And you look at it and you say, well, of course we would want to pick it, but the client doesn't pick it. We don't pick it. The insurance company actually assigns people the rate class, as I'm sure most of you know. But we get that question a lot. Why wouldn't I just choose a Preferred Plus? It's because you don't actually, none of us really get to pick it. And so I pulled this chart from one of our insurance companies. I really like this one for sort of the flow through. How do insurance companies look? They get an application on their desk. Everybody starts off at a preferred best category here on the left. And essentially, insurance companies start to work down the list. So the first thing they're looking at, has this person used any tobacco or nicotine within the last 5 years? No? Move down. So we're still in the preferred best column. Move down and let's look at their blood pressure. Let's look at their cholesterol. Let's look at their family history. What if this same person said, I quit smoking 2 years ago? Well, then they'd look at it and say, any tobacco or nicotine use within the last 5 years? Yes, it was 2 years ago, so we need to move next. Has there been any within the last 3 years? Yes, move right. Any within the last 12 months? No. And the start down on that column. So you can sort of see, I really like the flow chartiness of this, if that's a word. If it's not, I just coined it, trademark. Flow chartiness, and just to give an idea of how insurance companies look at people. So that underwriter gets an application on their desk. Everybody starts at Preferred Plus and starts to work down all these different things. Do they fly planes? Where do they travel? Any history of alcohol or drug abuse? So all of those things go into assigning a category. So we get a lot of questions. We get a lot of information about clients. We ask them these questions and more, and go to the insurance companies and say, here's what this person has going on. What do we think we're going to get as a rate class? And they give us an estimate. So it's an estimate, but they're looking at much bigger charts than these, or books, and it's probably computers anymore. I still think of them as big phone books. Some of you may not know what phone books are, but I still think of them as big phone books that they're flipping through. And so that's how it happens. The insurance companies, the underwriters, are assigning people rate classes based on all of these things and more. So we don't pick the rate classes, but what we do and work really hard to do is get this information so that we can do sort of this for lots of different companies and figure out who's the best fit. Recreational marijuana, that question came up. It really depends on the insurance company. Some say a couple times a year, 3 or 4 times a year, we're not going to worry about it. Some say 3 or 4 times a month, we're not going to worry about it. A few might say 3 or 4 times a week. You're not going to get Preferred Plus. Maybe you won't get Preferred, but you can get the, like in this category, what they call the third best, non-smoker plus. If you wake and bake, that's where it gets hard to insure people. And then the next question that a lot of people ask, what about medical marijuana? Medical marijuana, insurance companies look at the marijuana much less than what's the reason for the prescription, which is where it can work against people. Oh, I don't really have anxiety. I just had, weeddoc.com do that for me so I could buy my weed legally. Well, under the medical records and all these things, you have a diagnosis of anxiety. So that's what the insurance company is going to look at. More so, again, depends on how often you're refilling your weeddoc.com prescription. And again, if that's not already been taken, I call that one too. So trademark Flowcharty and weeddoc.com if that's not already out there. I'll go see if I can. Not that I'll be able to do it, but maybe I can get the domain name and have somebody buy it from me one day. Moving on. We've got a lot of these questions a year ago. Will we be covered under death or for our life insurance by an illness, by an accident on our life insurance policies? And then it would be, is there a COVID exclusion? Because there's a lot of bad information out there. And so much so that it's like the Association of Life Insurance Council had to post something that says there are no COVID exclusions on our life insurance policies anywhere, period. So Are there any circumstances where the insurance won't cover us? So there's lots of things in those couple questions, but if you have a life insurance policy, you're covered for illness, accident, essentially anything. COVID, covered. There are 2 times, though, with a life insurance policy where it may not pay a death benefit. So all insurance companies have a suicide period of time. It's usually 2 years, where if the insured commits suicide within the first 2 years of the policy, there's no death benefit paid and premiums are returned. After 2 years, though, fully covered. So I guess insurance companies have determined that if you bought a policy just to commit suicide and leave money to somebody, most people won't be able to do that after 2 years. 2 years is just, it passes. So it goes kind of against a lot of Jessica Fletcher Murder, She Wrote's scenarios where somebody bought life insurance 2 months ago and then commit suicide to leave money to somebody. So it won't work. Additionally, there's a 2-year period after the policy is issued called the contestability period. And so this says, in the first 2 years of a policy, if it's not suicide, the insurance company retains the right to research the death. Because you know what? Most of the time, there shouldn't be one. Now, there can be, and their claims are usually paid, no problem. But they're going to research it to find out, is there something that wasn't disclosed? Because for the most part, that shouldn't happen. It can, and law large numbers says that it will, but we're going to take a look at this. Is there any sort of material misrepresentation that impacts the policy? So I forgot that I take a cholesterol medication, not material. I had 2 heart attacks last year, that's material. So what would happen in those 2 years? If it's a misrepresentation that still would have let the insurance company issue a policy, so for example, they'll still pay a death benefit. So let's say they were a smoker, but somehow got through the process without determining there were that. They die of lung cancer within 2 years, and the medical records say that they're a 2-pack-a-day smoker. The insurance company is going to say, you misrepresented when you said no, that you don't use tobacco. So your $1,000 premium was paying for a $500,000 policy. We should have issued it as a smoker. And so we're going to, you were paying $1,000 a year, that actually is going to pay should have been a $250,000 policy. The premiums are twice as much, let's say, for smokers. So still pay a death benefit, but what the lower death benefit on what those premiums would have been. If it was something where they would not have issued a policy, then the insurance company will return the premiums and pay no death benefit. So like our 2 heart attacks, maybe bad life choices, illegal drugs, something like that. They can say that's something that we would not have even issued a policy. That was a material misrepresentation, would not have issued, and here's your premiums back. But after 2 years, pretty much everything's good. So I realized that may be more information than anybody needed or even wanted, but like knowing not to cross the streams, I hope it was educational. We get the questions in our quote requests or in our quotes when we send them out. We include the quotes, premiums, the amounts for the company, but then ratings at the back. And so one of the questions we get a lot is, what do the ratings mean? Well, and for it's something that a lot of clients ask, probably a lot of you already know this, but insurance companies have rating agencies that look at their assets, their liabilities, their debt, and assign different ratings. What makes it tricky sometimes is that, as you can see here, S&P's 4th best is AA minus, big A minus. Moody's is big A, little a3. So as a layperson, you would have no idea what those mean. So on here, what's nice is they put a number next to it. So that means that that's S&P's 4th best, Moody's 4th best. So it helps give an idea of what do those actually mean as comparison to their own rating systems. And then how to compare them. They can be all over the board, A+, A minus. We look at that Comdex ranking at the very bottom. And so it smushes all of those different rating agencies together and assigns them a percentile, 0 to 100. And I can't remember if it's the top 500 insurance companies out there or 1,000, and it assigns them a percentile. And even though some company might have a 2 here and a 4 there, and an insurance company might have a 3 here and a 3 there, it assigns them a category. So it smushes all those together to give a percentile on where they rank compared to all the other insurance companies. So why do we select one particular insurance company over another when we're looking at recommendations? Well, at the core of them, term policies are essentially going to be the same. They have a level premium, fixed death benefit, fixed premium period. Now, there can be nuances like conversion options. Some companies may have multiple policies available for conversion. Others may have 2 or just 1. So there are some nuances there, but for the most part, using it as term insurance, all plans are going to be fairly similar. So the first thing we look at is, like my underwriting guide, which is flowcharty, which insurance companies are going to offer somebody the best rates. Then after that, we look at the financials. So even before we recommend a company to be in our sort of stable of companies, we're looking at an AM Best of A or higher, so top 3 rating, and a Comdex ranking of 80 or higher. So top 20% of insurance companies, and using the AM Best, top A plus or A double plus. And like I said, the Comdex score, it's a ranking. So it's not actually a rating agency. It's just a score that smushes all those together and compares companies to each other. So Pacific Life with this Comdex of 95 means it's in the top 5% of insurance companies based on their financial ratings. Why don't we look at waiver of premium? Well, in general, qualifying for waiver of premium with most insurance companies is fairly hard. It's many times it's very similar to the Social Security disability definition. And the cost for what you get is very high compared to an individual disability policy. So you may pay $50 for a waiver premium rider on a $250 or $300 term premium. Percentage-wise, that's really high. So having group disability coverage is a better plan to be able to pay for that, because you can use that income for whatever you want. Individual disability is a better cost-benefit ratio. Or, if something that, that's a $250 a year premium, hopefully, even if you aren't able to work, you can make that payment for a year or two, because it'd be probably really important to keep it. And then, I think it a lot of times it's just thrown on to term policies because it increases the premium and increases the commission. We tend to like things to be a little plainer, a little more vanilla, get policies that do exactly what they're going to do, and then use, in this case, group disability, individual disability for income replacement. And the last thing I'm going to talk about are immediate annuities. And there's a number of different payouts for immediate annuities. And there's a whole range of them. And the first one that I think everybody thinks of and maybe even afraid of is the lifetime only. You give the insurance company $100,000 and it's going to pay $1,000 a month for as long as Peter Venkman lives. And whether that's 2 months or 50 years, the insurance company pays as long as Venkman is alive, but he could, in theory, die after 2 months, get $2,000 worth of payments, and the insurance company holds on to the rest. Usually has the highest payout because of that, but there is that possibility that you aren't going to receive, you get hit by a bus and receive only a short number of payments. On the opposite side is period certain. So this is a fixed number of payments, fixed number of years, 5 years, 10 years, 20 years. It has nothing to do with life expectancy or how long you live. It's going to pay for 10 years. In this case, 15 years. It pays for 15 years. So I have this 15-year period certain policy. I receive benefits. I receive my $1,000 a month for 5 years. I die. My beneficiaries get $5,000 a month for the next 10 years. $1,000 a month is paid out to somebody, whether it's me, my beneficiaries, beneficiaries. It's fixed. It's exactly what it is. It has nothing to do, the number of payments has nothing to do with my life, just really, I guess, how many I get, because I guess I don't get them if I'm dead. So somewhere between those, client said, I like the idea of having it last as long as I do, but I don't like the idea of if something happens to me right away, get hit by that proverbial bus, then nothing goes to anybody. The insurance company keeps $98,000 of my $100,000. So then we can blend the two, a lifetime with a period certain. So it will say, we're going to pay a life, let's say a life plus 10, life plus 10 years. It's going to pay for the longer of, as long as the client's lifetime or 10 years, whichever comes first. So if the client lives for 15 years, it's going to pay for 15 years. If the client dies after 5 years, it's going to have paid to the client for 5 years, and then have paid to the client's beneficiaries for another 5 years. So making up that 10 years. So it's a way to balance now the longer you have that guarantee, the lower the premiums, the lower the payments in general, because the more certainty you have, it's going to reduce that life only, that life contingency part of it. And then I think probably my two favorites are the next two. Egon's looking at this one, life with installment refund. So in this case, using very round numbers, $100,000 single premium, pays $1,000 a month. It says it will pay $1,000 a month for as long as Egon lives, or until the $100,000 has been paid out, until that single premium has been paid out. So it'll pay $1,000 as long as Egon lives, but never less than 100 $1,000 payments. So make sure that the whatever has been put in is definitely going to be paid out, and it gets paid out in installments. Life with cash refund, very similar, except that it's going to pay for as long as Slimer lives. If Slimer dies after 10 years, having received $10,000 in payments, instead of $1,000 payments going till the other $90,000 is paid out to his ghost kids, the ghost kids get a $90,000 lump sum. So the installment refund, make sure that the single premium is paid out, but in installments. Life with refund, any remaining amount that hasn't been paid out from the single premium is paid in a lump sum. All right, so we covered spooky questions about long-term care insurance, disability insurance, even life and underwriting. So Jerry is going to be at the ACP conference next week. Is that next week already? Yeah, in Atlanta. And Jerry and Jill will be at the XYPN Live in Denver in a couple weeks. So looking forward to seeing people in person again. We are just about to open up registration, I believe this week, for our LOIS Insurance Academy. We didn't do it last year, but it's going to be a day at the beach. And we have it scheduled for February, end of February. And come listen to us talk about insurance, but most importantly, it's Florida in February. And we're excited to see people again and host the Insurance Academy again. So for those of you who are new to LLIS, or haven't listened to a webinar before or in a while, we do a David Letterman style, what are the top 10 things that make us different, things like this. The free monthly webinars, we have a few left at the end of the year. It's hard to believe it's the end of the year already too. We're not your competition, so we work with you all. We only work with fee-only advisors, and we do a lot of things to help try and save you and your clients time and money. And one of the things we really try to do is pre-underwrite to avoid surprises, using those charts that are flowcharty trademark, Flowcharty to find the best fit for people. We have tools on our website, proud sponsors of all the different fee-only groups out there, and it's been a wonderful relationship for over 20 years with us. Not quite 20 with me yet, but it's creeping up. We have specialists. They're spooky specialists in life insurance, disability, long-term care, annuities, and hybrids. And we manage your clients' spooky policies now and in the future with some of our systems that we've added over time that advisors have asked us for. And Alice, she's spooky. It's our advisor portal, and hoping for some neat changes to it in the coming months. And it is 5 o'clock, 5:01. Thank you everybody for tuning in. And I think I see one more question here, and then any others I'll reply to at different points in the next couple days. One of them is, if a waiver of premium rider is included on term policy, can it be removed after the policy is issued in order to reduce premiums going forward? The answer is yes, or it should be. Should be able to just be removed. It's a rider, so it's something attached to the policy, not built in or baked into the base policy. So it should be able to be removed from the policy. Another question, long-term care COLA. Okay, so the inflation rider on, oh, no, it's long-term care, long-term disability COLA. So the cost of living works on a long-term disability policy when it's on claim. You have your future increase options, and so there's usually two types of increase options. One is an automatic increase. So if you have a $5,000 monthly benefit, some insurance companies for the first 4, 5, 6 years of the policy say, we're going to automatically increase your $5,000 monthly benefit by 3%, 4%. Kind of like an inflation cost of living adjustment. So it's similar how we think of it. So it may increase your benefits from 5,000 to 5,200 or 5,400. You pay a little bit more for it, but it's still a future increase that's going to increase the benefits before you go on claim. That may have been as clear as mud. So I will, as I realize it may not be super clear. So I will try and reach out and see if I can do that one again. Thank you everybody for tuning in. Everybody have a safe and spooky Halloween, and thank you for being here, and stay safe. Bye.